When modeling the return on investment for accounting automation, the standard methodology relied on by most chief financial officers is broken. Traditionally, firms rely on a strict linear equation to justify new technology. They weigh the hard cost of a software license directly against the raw number of employee labor hours they expect to eliminate. Evaluating sophisticated financial architecture through the lens of baseline payroll efficiency creates a severe blind spot. It treats a highly technical department like an assembly line, assuming the only path to value is producing the exact same output with fewer human hands. Recent field metrics from automated firms point to a very different operational outcome. The data shows that stripping manual tasks out of the accounting cycle does not just make the workflow cheaper, it accelerates the utility of the ledger itself. The ultimate value extracted from automated systems is not the reduction of overhead. It is the exponential increase in decision velocity, giving a firm the ability to act on financial realities the moment they occur. To understand exactly how this acceleration happens, we need to bypass the top-line labor arguments and look directly at the specific ledger-level metrics where human friction traditionally slows down the flow of capital. The defining constraint here is data latency. This is the exact measured time delay between an operational event, like a vendor invoice hitting an inbox, and its verified appearance on the financial ledger. That gap is the enemy of effective corporate strategy. As long as financial leadership clings strictly to a labor hour reduction model, they remain completely blind to the fact that lowering latency is the actual strategic upgrade automation delivers. Look at the ingestion mechanics of a standard unautomated ledger. Every transaction requires a human to manually key in figures, verify routing numbers, and hunt down missing receipts before a single dollar can be properly categorized. When automated ingestion protocols take over those rote categorization steps, firms consistently report a 40 to 60% reduction in manual data entry time. This diagram illustrates how that time reduction functions as a primary latency filter. By automatically mapping and coding routine transactions, raw financial data passes straight through the system without waiting for manual processing, causing the entire output stream to move significantly faster. But speeding up data entry only solves the first half of the ingestion problem. The secondary, and often more severe, friction point in traditional accounting is the constant cycle of manual auditing and error reconciliation. Because automation removes the risk of human keystroke mistakes, these systems yield 30 to 50% fewer reconciliation errors. As seen here, a secondary filter automatically isolates and strips out systemic anomalies before they embed themselves in the ledger. Eradicating these discrepancies at the immediate point of ingestion removes the single largest bottleneck that causes traditional accounting workflows to freeze. Instead of an entire controller team halting their primary duties for 3 days to track down a single misplaced decimal point, verified data flows cleanly into the general ledger without interruption. These efficiencies ensure the data stream is purified at the source, establishing the structural integrity required for high-speed downstream processing. All of this daily data ingestion builds toward a single, immovable operational deadline for every financial firm, the month-end close. The speed and accuracy gained during daily transaction processing do not operate in isolation. They compound heavily as the month concludes. This timeline visualizes the primary operational yield. Because the data has already been reconciled at the point of entry, the standard month-end close timeline shrinks dramatically, consistently finishing 2 to 5 days earlier than manual equivalents. Recovering up to a full business week of operational capacity corrects the daily rhythm of the accounting department. Tasks that usually require overtime are completed comfortably within normal working hours. This speed creates an immediate, collateral financial defense. With invoices processed and closed faster, firms report a significant reduction in late payment penalties and are positioned to capture early payment vendor discounts. Naturally, applying acceleration to strict financial processes raises a critical concern. Controllers often assume that moving faster inherently compromises the thoroughness of their supporting documentation. The exact opposite occurs. Because every automated action is digitally stamped, these systems achieve 100% audit trail compliance, completely eliminating the need for manual record-keeping. The system builds this pristine, immutable audit trail as an automatic background byproduct of that initial high-speed data ingestion we looked at earlier. Contrast this cryptographic certainty against the traditional end-of-month scramble, where finance teams burn hours digging through email attachments and physical filing cabinets to prove basic transaction histories to external auditors. Yet, even considering the weight of these timeline compressions and ironclad compliance guarantees, we are still looking strictly at operational metrics. The combination of a compressed close and a verified audit trail converts the ledger into an operational asset, replacing its role as a lagging historical record. Pulling back from the ledger mechanics allows us to analyze how these specific operational metrics dictate the reality of executive firm leadership. This dual timeline models the management shift. At the top is the standard reactive model governed by manual accounting. Here, historical data arrives late, a market event occurs, and leadership is forced to react after the fact. Relying on a standard 10-day close physically prevents agility. It structurally guarantees that by the time executives review their cash flow, they are making critical strategic decisions based on financial data that is already 2 to 3 weeks out of date. Now look at the proactive model mapped along the bottom, unlocked entirely by continuous, automated data streams. Real-time numbers arrive, leadership anticipates the upcoming market event, and decisive action is taken before the impact hits. Reclaiming 2 to 5 days from the month-end close creates a critical window for anticipation, giving leadership the time to pivot a firm's position forward before market events settle. This shift marks the precise moment the accounting function graduates. It stops being a department dedicated to retrospective record-keeping and becomes a forward-looking advisory engine driving the entire firm. The ultimate takeaway is clear. Compassing data latency across the ledger is the absolute mandatory prerequisite for achieving genuine strategic financial leadership. This brings us to the final, necessary question for controllers and partners building an automated system. What happens to the human capital trapped inside the old model? The data yields one final pivotal metric. After eliminating rote tasks and compressing the close, automated firms generate a massive 40% increase in available accounting bandwidth. This bandwidth functions as raw strategic capacity, a resource previously bottlenecked by manual entry that is now available for high-value deployment. Liberated from basic reconciliation, senior accountants immediately redeploy this capacity. They transition their hours into executing complex cash flow forecasting, conducting rigorous mergers and acquisitions analysis, and providing deeper, customized operational advisory to their B2B clients. Returning to our initial premise, it becomes evident that calculating ROI by strictly counting labor hours saved is mathematically inferior to measuring the total capability expansion of the finance team. Ultimately, the highest quantifiable value of accounting automation is achieving the frictionless data velocity required to act immediately. The highest ROI is realized when a firm uses its new speed to make entirely different, faster, and better decisions.